A price target indicator is a technical analysis tool used by traders and investors to predict the future price level of an asset. When analyzing price movements, traders use various methods to determine where an asset's price might go next. Price targets help establish potential entry points, where traders might open positions, and exit points, where they could close them for profit or to limit losses. Price target indicators are based on various analytical methods, including technical patterns, support and resistance levels, or mathematical calculations. Ultimately, price targets represent estimated values that an asset might reach within a specific time frame, serving as key decision-making tools for investment strategies. Price target indicators can be categorized into three main types. Technical-based targets use chart patterns and technical indicators to project price movements. Fundamental-based targets rely on financial metrics and company performance data. Consensus targets aggregate price predictions from multiple analysts. Let's examine each of these categories in more detail. Technical-based price targets rely on chart patterns and technical indicators. These targets often derive from specific chart patterns, such as a head and shoulders pattern. The pattern projects a target by measuring the distance from the top of the head to the neckline, and then extending that same distance below the neckline. Technical traders use various methods to determine price targets, including chart patterns, support and resistance levels, and Fibonacci extensions. Fundamental-based price targets are derived from financial metrics and company performance data. These targets analyze key financial data such as revenue, earnings per share, and valuation ratios. Analysts often calculate price targets by applying a forward price-to-earnings multiple to forecast earnings. Consensus price targets aggregate predictions from multiple analysts to provide a more balanced view. Each analyst issues their own price target based on their research and valuation methods. The consensus price target represents the average of all analyst estimates, providing a more balanced viewpoint. Consensus targets offer key benefits, including reduced individual bias and a broader market perspective. Each type of price target indicator serves different trading styles and timeframes. Technical targets suit shorter timeframes from hours to weeks, making them ideal for day and swing traders. Fundamental targets work best for longer horizons of months to years, serving value investors seeking undervalued stocks. Consensus targets typically cover a 3 to 12-month outlook, making them suitable for position traders. Selecting the right price target indicator depends on your trading style, time horizon, and investment objectives. Technical analysis offers several methods for calculating price targets based on chart patterns. The fundamental concept behind these targets is the measuring principle. The head and shoulders pattern is a reversal pattern that signals a bullish to bearish transition. The neckline connects the lows of the pattern and serves as a critical support level. To calculate the price target, first measure the height from the head to the neckline. After the breakout below the neckline, project this height downward to find your price target. The double bottom pattern is a bullish reversal pattern indicating a potential uptrend. The pattern forms a resistance level at the top of the pattern. Measure the pattern height from the bottom to the resistance level. After the breakout above resistance, project this height upward to determine your price target. The bullish flag pattern is a continuation pattern that forms during an uptrend. After a strong move up, the price consolidates in a channel, forming the flag. To calculate the price target, first measure the height of the flagpole. After the breakout from the flag pattern, project the flagpole height from the breakout point to find your target. Let's work through a practical example using a bullish flag pattern on a stock chart. Our stock started at $60 and made a strong move up to $90, forming a flagpole. Then the price consolidated in a flag formation, moving between $80 and $90. To calculate our price target, we first measure the flagpole height, which is $30. The stock then breaks out from the flag pattern at $83. We add the flagpole height of $30 to the breakout point of $83. This gives us a price target of $113. And indeed, the stock continues its upward movement toward our calculated target. Fibonacci extension levels help traders identify potential price targets after breakouts. Unlike retracements, extensions project price movements beyond the original pattern. The most commonly used extension levels are 127.2%, 161.8%, and 261.8%. These ratios are derived from the Fibonacci sequence and have shown remarkable accuracy in predicting price movements. To plot Fibonacci extensions, we first need to identify significant swing points on the chart. These are the local tops and bottoms in the price movement. For an uptrend, we identify a significant swing low, followed by a swing high, and then another swing low. These 3 points form the basis for our Fibonacci extension calculation. To calculate Fibonacci extensions, we use 3 reference points: the start of a move, the end of the move, and the retracement point. The extension levels are calculated by taking the height of the initial price move, multiplying it by the Fibonacci ratios, and adding the result to the retracement point. These extension levels project where price might go after breaking out from the retracement. As we can see, when price continues upward, it often reaches these key extension levels. Let's examine a practical example of using the 161.8% Fibonacci extension level as a price target after a breakout. Here we see a stock that has formed a consolidation pattern after an initial move up. The price is trading in a range between support and resistance levels. When the price breaks out above the consolidation pattern, we can use Fibonacci extensions to project potential price targets. By measuring the height of the consolidation and applying the 161.8% extension, we get our target. Notice how the price reaches and reacts at the 161.8% extension level. In this case, our target was accurately hit, demonstrating the effectiveness of Fibonacci extensions in projecting price movements after breakouts. Fibonacci extension levels are more than just mathematical projections. They have significant psychological impact on market participants. Since many traders watch the same Fibonacci levels, they can become self-fulfilling prophecies. When a large number of market participants expect a certain level to act as resistance or support, their collective actions often make it happen. Price action often shows clear reactions at these extension levels. You may observe the price pausing, reversing direction, or occasionally accelerating through these levels with increased momentum. Many traders place their stop-loss orders just beyond these key extension levels, which can create volatility when these levels are tested. While Fibonacci extension levels provide excellent price targets, it's important to wait for price confirmation when these levels are reached. Look for candlestick patterns, volume changes, or other indicators to confirm how price is reacting to the extension level. Moving averages provide reliable price targets that can guide trading decisions. Mean reversion is the theory that prices and returns eventually move back toward the mean or average. When price moves away from its moving average, it tends to return to that average over time. The distance between price and its moving average can identify potential target zones. When price stretches far from its moving average, it creates an opportunity for a reversion trade. These target zones become more compelling the greater the distance from the moving average. The 200-day moving average is often used as a long-term price target during major trend reversals. During bearish market conditions, the 200-day moving average often acts as resistance. In a major trend reversal, prices often move back toward the 200-day moving average. This creates a clear price target that can be used for position sizing and profit taking. Let's look at real market examples where moving averages acted as price targets. During the 2020 market crash, the S&P 500 found support at its 200-day moving average during the recovery phase. As the market bottomed, the 200-day moving average created both resistance and eventual support levels. Moving averages offered precise price targets during this volatile period. Let's summarize the key concepts about moving average price targets. Moving averages provide objective price targets through mean reversion. The distance between price and its moving average indicates the strength of the target. The 200-day moving average is especially useful during major trend reversals, and you can use multiple timeframes to identify different target zones. Pivot points are technical analysis indicators used to determine potential support and resistance levels in the market. They are calculated price levels that help identify potential areas where price action may reverse or hesitate during a trading session. Unlike many other indicators, pivot points provide traders with objective price targets based on previous price action rather than subjective analysis. The standard pivot point is calculated using a simple formula that averages the high, low, and closing prices from the previous trading period. From this main pivot point, we calculate various support and resistance levels that serve as potential price targets. The first resistance level, R1, is calculated as 2 times the pivot point minus the previous low. The first support level, S1, is calculated as 2 times the pivot point minus the previous high. Second level targets are calculated by adding or subtracting the previous trading range from the pivot point. Pivot points can be calculated for different timeframes, providing traders with various strategic price targets. Daily pivot points are calculated using the previous day's high, low, and close prices. These are primarily used by day traders and short-term traders looking for intraday price targets. Weekly pivot points use the previous week's data and provide medium-term price targets, making them popular among swing traders who hold positions for several days. Monthly pivot points are calculated from the previous month's data. These are used by position traders and long-term investors to identify significant levels that may influence price over extended periods. Let's examine a practical example of how price action often respects pivot resistance levels as price targets. In this example, we have a price chart showing an uptrend approaching a calculated first resistance level, R1. As price approaches the resistance level, notice how it begins to slow down. This is often the first sign that the pivot target is influencing trading decisions. When price reaches the exact resistance level, it fails to break through and begins to reverse. This reversal happens precisely at our calculated R1 level, demonstrating how pivot points can serve as effective price targets. This example illustrates why many traders place sell orders at pivot resistance levels. These levels act as natural price targets where reversals frequently occur due to the concentration of orders around these mathematically significant points. Traders implement several strategies using pivot points as price targets. The reversal strategy involves entering short positions at resistance levels and long positions at support levels, anticipating price reversals at these key targets. The breakout strategy focuses on entering positions when price decisively breaks through pivot levels with significant volume, signaling a potential trend continuation. The range strategy involves trading between the first support and first resistance levels during low volatility market conditions, using these levels as definitive price targets. Let's recap some key points about using pivot points as price targets. Analyst price targets represent professional predictions for a stock's future value, typically over a 12-month period. The first method is discounted cash flow analysis, or DCF. This technique projects a company's future cash flows and discounts them to determine their present value. The second method is comparable company analysis. Analysts compare valuation ratios like PE or EV/EBITDA with similar companies to determine an appropriate price target. The third method involves growth-based projections. Analysts forecast a company's earnings growth over time, then apply an appropriate multiple to determine a future stock price. You can find consensus price targets on most financial websites and trading platforms. These platforms typically display targets from various analysts along with an average or consensus figure. When using analyst price targets, consider these key points. Most targets have a 12-month time horizon. The reasoning behind a target often matters more than the number itself. Pay attention to target revisions, as they may signal changing fundamentals. and understand that significant disagreements between analysts can provide valuable insights about a stock's risk profile. Remember that most analyst price targets are based on a standard 12-month outlook, so adjust your expectations if your investment timeframe differs. To summarize, analyst price targets offer professional valuation estimates based on rigorous fundamental analysis. They provide a useful external perspective on a stock's potential value. For best results, consider their time horizon, understand the reasoning behind them, and use them as just one tool in your broader investment analysis. Setting realistic price targets is crucial for successful trading. Let's look at an example price chart to understand how to set targets. There are 3 key guidelines for setting realistic price targets. Consider overall market conditions, analyze the specific volatility of the asset, and adjust your expectations based on your trading timeframe. A fundamental concept is the risk-reward ratio, typically aiming for at least 2 to 1. This means your potential profit should be at least twice your potential loss. In this example, if your entry is here, your stop loss would be placed below, creating your risk zone. Your target would be placed higher, creating a reward zone that's twice the size of your risk. Always adjust your targets based on support and resistance levels. These key price areas can act as barriers. Notice how our original target would push through resistance. A more realistic approach is to set targets just below major resistance levels, as prices often struggle to break through these barriers. Market volatility should directly influence your target setting. In low volatility environments, set closer targets with smaller risk-reward ratios as prices move less dramatically. In contrast, high volatility environments allow for wider targets and larger risk-reward ratios as prices can make more significant moves in shorter timeframes. Your trading timeframe significantly impacts appropriate target distances. Short-term day traders might aim for just 1 to 2% moves, while swing traders look for 5 to 15% moves over weeks. Position traders can target 20% or more over months. Setting unrealistic targets can be harmful to your trading. Targets that are too close leave profit on the table, while targets that are too far often result in unrealized gains, turning into losses as price retreats. Always ensure your targets respect the current market structure rather than fighting against the trend or major levels. To summarize, when setting realistic price targets, start with a 2-1 risk-reward ratio as your baseline, adjust for volatility in your chosen time frame, respect key support and resistance levels, and always remain realistic based on current market conditions. Professional traders rarely rely on a single price target method. Instead, they combine multiple indicators to identify high-probability target zones. Confluence occurs when multiple independent technical indicators point to the same price level. This increases accuracy, reduces false signals, and strengthens trading conviction. Let's examine 3 powerful price target methods that work well together: Fibonacci extensions, pivot points, and psychological round numbers. Let's examine a price chart and apply our target indicators. This shows an uptrending stock with recent consolidation. First, let's apply Fibonacci extensions based on the recent swing. Notice the key extension levels at 127%, 161.8%, and 200%. Next, we'll add pivot points calculated from the previous price action. These include the pivot point itself and key resistance levels R1 and R2. Finally, we add psychological round numbers: $80, $90, and $100. Traders often place orders at these even price levels, creating resistance or support. Now we can see a clear confluence zone around the $90 level. The 161.8% Fibonacci extension, R2 pivot level, and the $90 psychological round number all converge in this area. This confluence creates a high probability target zone. When multiple independent methods confirm the same level, we can expect stronger resistance or support. Such zones can inform both entry and exit decisions in your trading plan. Let's examine common mistakes traders make when using price targets. The first common mistake is setting and forgetting targets without adjusting to changing market conditions. When you set a target and don't adjust it despite changing market conditions, you might miss opportunities to exit at better prices or hold losing positions too long. The second mistake is ignoring overall market trends. Individual assets rarely move in isolation from broader market conditions. Finally, using price targets without stop losses exposes traders to unnecessary risk if the market moves against them. Now, let's explore best practices that can improve your success with price targets. First, regularly reassess your targets as new information emerges. This keeps your analysis current and responsive to market changes. As new information becomes available, adjust your targets accordingly. This allows you to capture more profit or minimize losses based on evolving market conditions. Second, consider scaling out of positions at different target levels rather than exiting all at once. This approach helps manage uncertainty. By exiting portions of your position at different price targets, you can secure profits while still participating in potential further upside. This approach acknowledges the uncertainty in predicting exact price movements. Third, document the reasoning behind each target you set. This creates a valuable learning tool for improving your analysis over time. A well-maintained trading journal helps you identify which analysis methods work best for different market conditions and improves your future decision-making. Perhaps the most important practice is to treat price targets not as exact prices, but as probability zones where price action is likely to develop. Markets are dynamic and probabilistic. By approaching price targets as zones rather than exact levels, you acknowledge market uncertainty and set more realistic expectations for your trading strategies.